Hello, everyone. I'm presenting you a presentation for the African Mining Summit called Mining Investment in Africa, Trends, Case Studies, and Recommendations. And this is from experience in the field throughout the period of 2019 to 2021. I look forward to sharing these ideas and trends and recommendations with you. There's 5 parts to this presentation. Part 1, mining industry trends affecting financing. Then I will talk about mining investment fundamentals. Going from there, case studies 2020 and 2021 for different commodities. Then looking at financing trends. And lastly, recommendations for financing, particularly for mine developers and mineral policy makers in Africa. The first trend is EV metals. There is a surge in demand. The indices are quadrupling year on year. Prices are growing significantly for lithium, for rare earths, for nickel, copper, and you can see it on a monthly basis how more and more electric vehicles work and drive around in a country like Germany. So there's a huge demand and a growing demand. Where will this come from? From mining. The second trend that affects financing is community emancipation. Here we have an example of RBM having to remain closed and ultimately calling in a force majeure because of community unrest, or Zolobeni, the Zolobeni community, where there's a battle to stop the mining project on the Wild Coast for multiple reasons. But ultimately, if you unpack it, community emancipation, community not being satisfied with what has been promised by the mining project. Also, there's a political agenda, and that is a situation that mining projects in Africa face. A further example is that of Total in Mozambique. Another trend is gold. Gold remains the stable asset class during the COVID period. It's a key investment to have. It doesn't suffer from inflation. It's a hard asset. The demand never ends. And it's with currencies up and down, gold is the asset class that many investors want to invest into. So there's a huge demand. Going into coal, there's a huge anti-coal lobby. However, the demand for coal increases. So here you have an example. Allianz stops insuring coal companies. This is hugely to the detriment of financing. How can you finance a project without insurance? At the same time, you've got Pakistan, April 2021, imports up by 28%. There are conflicting forces. There's an anti-coal lobby, but there's a growth in demand. This affects financing. Another trend is that of mega mining projects battling to secure large amounts of capital, and as a result, having to downscale and downsize to manageable modular units. So a trend important for financing of mining projects. Next, I look at mining investment fundamentals. When you want to invest into a mine, go back to basics. The basics are a strong mining business case, from reserves, mining, processing, product, logistics to customer, with licenses intact, stable host country policies, a strong team. That mining business case needs to be intact. For the multiple financing options below, you can see equity, debt, DFI, contractor finance, equipment finance, streaming, offtake, and royalty finance. contractor vendor finance. These are all the pots of money that are there, but they only will provide capital if the mining business case is intact. These are the fundamentals. Now, let's talk about case studies 2020 and 2021 for EV metals, gold, and coal mining projects, showing and highlighting to you these trends. So the first EV metals project is in Southern Africa. It entailed the development of a mega mining project that had to be downsized to a smaller operation, fully licensed, 50 million tons of titaniferous magnetite ore, vanadium bearing. Just one seam alone was 50 million tons. The entire ore body was about 500 million tons. The product is vanadium, titanium, and iron ore for metal traders, for the EV market. Mining method is open cast, and the processing is crush, screen, and smelting. The production was sized down from large numbers to starting up at 2,000 tons per month, going to 20,000, and then growing to 50,000 tons per month. And you can see the capex to begin with $1 million, $25 million in phase 2, and $70 million in phase 3. So the financing. The realities were that the project was unable to secure finance for the large-scale mine of $70 million. The initial financing was even significantly higher, but $70 million unable to secure that money. So the strategy here was to re-engineer the project to a small-scale mine producing high-grade product, high-grade ferrotitanium. The type pre-production finance. Then in part 2, look at project financing to produce vanadium. And the term sheet that was negotiated was a pre-production finance facility of $1 million to start a small, really small open cast mine and a small exothermal furnace to produce high-grade ferrotitanium. And then on that success, scale up to a project finance facility of $25 million and later $70 million. The next case study is a gold mining project in Central Africa. At stage mine development, feasibility has been done. It's fully licensed. There's a reserve of 500,000 ounces. The product is gold doré. The market is a streaming company, and ultimately it goes into the gold vaults. The mining method, initially open cast, later underground. A CIL processing plant is part of the capex. It will produce 30,000 ounces per annum, and the capex $8 million, a small mine. So the financing of this particular project had the following realities, strategy, and term sheet. The realities: gold projects are easier to finance. There were multiple options for the mine developer, such as equity, streaming, contractor, and debt finance. The financing strategy here was a streaming finance facility where the funder was repaid in bullion to capitalize the mine with minimal dilution for the shareholder. It's a facility of $8 million, and the funds were used to build the gold processing plant, to do the box cut and site establish, and repayment in gold doré. The next case study is a coal mine in Southern Africa. It's at a construction ready status, fully licensed. There's plus 80 million tons of coal reserves. It's export coal. The market is a coal trader. It's open cast mining. It's coal washing, the production of 75,000 tons product, and capex in excess of $40 million. The financing of this particular project proved that coal projects are very difficult to finance with the current green focus. Reality, many banks do not finance coal anymore, and innovative financing is required from within the industry, such as coal traders seeking coal, mining and processing contractors seeking projects, and equipment suppliers seeking a mine to deploy the equipment. And another initiative and another reality is that it can only go forward if there is some form of clean coal initiative as part of the project. It's essential. The coal industry has to get its act together. An undercapitalized coal industry will only lead to more global warming. It's all about cleaning up, producing clean coal as best as is possible, and looking at technology and innovation. So the financing strategy was the use of a combination of financing sources from within the coal industry. A facility of $40 million, equity, offtake finance, and contractor finance. Use of the proceeds to build the mine with attractive returns for investors and coal supply for the coal trading house. So, the trends. EV metal projects are easier to finance. Gold projects close to production are easier to finance. Coal projects have got limited options only. Mega mining projects are difficult to finance. And project and DFI financing is only available for large projects in approved commodities such as EV metals and in approved jurisdictions. There are limited financing options for exploration, and there's no financing if there's no community buy-in. A key ingredient, community buy-in. So, my recommendations for financing of African mining projects going forward. EV metals and minerals, there's a growing demand. Focus on these. Focus on gold projects close to production, ready to produce gold. On coal projects, partner with coal industry players and support and have clean coal initiatives as part of your project. For mega mining projects, re-engineer them to smaller, bite-sized modular units with later growth for project financing. Exploration, seek partnerships with major miners close to the exploration project, and then buy in from the community. A key and an essential project parameter, community buy-in, make sure that this project is ESG compliant. That's my presentation. I hope you enjoyed it.